Hey guys, today I found a new post on Reddit by a user named throw-away-ac-slater. Basically talks about he has about $60,000 to invest in an index fund and wants to know if he should do it as an all-in or should do a DCA, which is dollar cost average. The basic post reads, I have been saving a lot in the past 1.5 years, and mistakenly, I have not been investing at a regular rate. Long story short, I was preparing for something that never came, so now I feel comfortable investing it in long term. Investing it all at once does not seem right intuitively, or maybe I'm wrong about that. I'm not trying to time the market, but trying to do it in a way that makes sense over a long average. Or does a strategy of investing over a long average not making sense either? Makes sense either since the money is losing value just sitting in savings. Um, it's a good question. Whether or not can you do a dollar cost average versus should I put it all in as a lump sum? Does not give too much of an other um, basis to know what I'm about to say, but I think the short answer to your question I think is that lump sum is actually a generally a good idea, and I'll talk a little bit more about that towards the end. Uh, Compared to dollar cost average, when you have an extra lump sum to put in all at once at some point. Um, One other thing about the, I guess, investing, especially in the stock market and things like that, is that, or just I guess anywhere really, is that obviously you want to have an extra cushion, right? Because when you're investing, you gotta kind of treat it like almost as if it is illiquid. Now, of course, the best thing about stock investing in like especially in a brokerage account rather than in like a IRA or something like that is that they are liquid, right? Meaning if you need to pull it out, you can. You have an option to do so. But obviously, generally speaking, and I'm guessing that's what you're saying about long-term investing. So I'm sure you're aware of that. But you'd never want to be in a position where you have to liquidate it just because of a reason or another. I think that's why having a good amount of cash set aside is good. Somebody mentioned about perhaps buying some bonds or something like that to kind of set it aside so they don't quote unquote lose money over the term. So again, have a sufficient enough emergency fund set aside where you don't necessarily have to pull money out of the market if something were to happen or anytime soon. Obviously, as you know, like timing the market is almost impossible, right? So try not to time the market whether when it's like, hey, should I try to invest money in now or like a couple months from now, a couple of years from now? It's all generally speaking because what we as an investors typically believe is that the market always goes up, right? I mean, not always goes up, but eventually goes up, right? The market goes up over a long time, so that's why you're investing, right? You give $1,000 in investment, and you hopefully get more than $1,000 back, right? Um, and so if that's the case, if you think the market is going to go up, which they tend to do, then obviously the earlier you put in, the better it will be. And then same goes same goes without saying that obviously if that's the case, the earlier you put in, the better it will be. Having said that, obviously there will be ups and downs and ups and downs. And I've done the math before in a simple Excel sheet. So take it for granted, a grain of salt. But um, with the few amount of scenarios that I ran, it looks like again putting all the money up front makes better return only because you end up buying some at a below whatever the current price is because the market goes down. But eventually, what that also means is that you will also buy things as they go up, right? If you only had $60,000 to invest, right, and if you dollar cost average it over, let's say, a year or 2 years or what have you, at some point you'll buy some things that are below the current market price, but you would also eventually end up paying more, buying more things when the market is higher, typically, right? So at let's say 5 years from now, 10 years from now, when the portfolio performing at a lot better, your cost basis is actually higher, just because, again, if we believe the market tend to go up rather than down, then obviously you ended up purchasing at a lot higher price. Now, as psychologically, is it better? Is it to do it that way? Again, I'm not so sure, just because unless you have it automated, invested automated, say, hey, I'm gonna withdraw $500 per month, for next however, or $5,000 per month for the next whatever. Like, unless that's the case, you have it automatically set, which allows you to not really think about things, right? Which is the benefit of having a psychological factor, right? Unless that's the case, I think like if I'm manually buying things, I would always try to time the market to a degree, versus if I just, if I have a lump sum of $60,000, I would say, hey, here's $60,000, let me just buy the whole thing, let it just sit there, whether it goes up or down. I think that would be a quote unquote interesting, or the better way of investing that $60,000. Now, one interesting aspect about the money losing value in the savings and inflation and things like that, just also know too, is like, if you actually look at the asset allocation, cash is actually a good place to put your money in, like whether it's you have some stocks, bonds, and cash. And I actually saw a video, short clip from Mark Cuban, who had a thing to say about the cash position. And he says, I'm paraphrasing it, so I'm not 100% sure exact. I don't recall exactly what he said, but what he said was, a lot of people are worried that if you have too much cash, or quote unquote, you lose value over the term. I think what he said was, you could actually, the one easy way to hedge it is to buy things that you need. Like, I think the example he used was like a toothpaste and a toilet paper or something like that. And he said, go out, for sure that you need to buy some toothpaste, and how much space does a toothpaste take? But everybody needs it, right? You always need it. You're always gonna brush your teeth, right? So what he's saying is, go out and buy a couple of boxes of toothpaste, and for sure you can set it aside, and it doesn't take up that much space, so you can store it, and you can use it over the years and stuff like that. Napkins, things like that. They're irreplaceable for any foreseeable future, right? So things like that, you can get it at a cheaper price before the price goes up higher. So that's something to think about. Obviously, you don't want to buy $100,000 worth of toothpaste, right? That'd be dumb. But you can do things like that where for sure you're gonna need it down the road for a reason or another. So if it's something that you have to get, you're gonna get, you must have to get, just because of the day-to-day things, and if you have an extra cash that you don't feel comfortable investing in, then those are some of the things you can do by, I guess, quote unquote, hedging it against the inflation. Hope this helps. Let me know leave me some comments below about what I can do to possibly improve the quality of the contents that I'm providing. So thank you guys. Thank you.